Okay, you are not going to believe this headline I saw. JP Morgan is forecasting gold hitting $4,000 an ounce.
4,000.
$4,000
Oh.
by mid-2026. Seriously.
Wow. Okay.
So that's what we're diving into today, right? This
Yeah.
huge JP Morgan analysis on, where gold and silver might be headed.
Exactly. Yeah, you shared that report. It's pretty dense. So our job today is really to cut through it for you.
Yeah, unpack it a bit.
Pull out the key stuff, explain the how and why behind these, frankly, pretty bold predictions.
Yeah.
We'll look at the factors they think are driving this potential bull run.
And try to make sense of, well, all this global finance stuff.
Right, because it can get bewildering.
Okay, so JP Morgan, $4,000 gold. They're making a strong case. What are the main reasons they see this happening?
Well, right up top is geopolitical and economic uncertainty. A whole lot of it.
Okay, like what specifically?
They're really flagging the risks of, say, a recession that's maybe driven by tariffs, even stagflation, which is, that nasty mix of slow growth and high inflation. Ugh, stagflation.
Right.
Yeah. And the whole ongoing U.S.-China trade situation, those boosted U.S. tariffs, that's a big piece of the puzzle, according to them.
Okay.
Plus, just general unpredictability, economic policy, U.S. policy, shifting alliances around the world. It's all creating this climate.
The climate where gold looks pretty good.
Exactly. The classic safe haven appeal. Gold tends to do well when things feel unstable.
That makes sense, yeah. The port in a storm idea. But it's not just jitters, is it? I think you mentioned central banks are a big factor, too.
Oh, absolutely. Huge. Central bank demand is like a cornerstone of this forecast. They're actually projecting 900 tons of buying just from central banks in 2025.
900 tons. That's a lot of gold.
It is, and it's not totally new. We've seen this trend for a while, right? Diversifying reserves away from the U.S. dollar.
Yeah.
Now, interestingly, the dollar share of reserves did tick up slightly at the end of last year, ended 2024 at about 57.8%.
Okay.
But JP Morgan thinks the bigger picture, the move towards gold, that diversification, that's set to continue.
And what about the whole Russia situation?
Ugh.
Getting cut off from SWIFT, does that still play a role?
Yeah, they mentioned that specifically, the uncertainty about, maybe Russia re-engaging with the West someday. They don't think that's going to stop the gold buying.
Why not?
Because that SWIFT cutoff in 2022, it was a real wake-up call for a lot of countries. It showed the risks of relying too heavily on, well, certain currencies or systems.
Right. Don't keep all your eggs in one basket.
Pretty much.
Yep.
So gold looks safer, and we're seeing the buying already, right? In 2024, Poland, Turkey, India, Azerbaijan through their oil fund, SOFAs, China, Czechia, Iraq, all bought over 20 tons. These are reported numbers.
And is there potential for even more central bank buying beyond that 900 tons?
Oh, potentially, yes. They really emphasize this. Think about countries with massive reserves, but maybe a pretty low percentage actually held in gold right now.
Like who?
They point to China, India, Japan, Saudi Arabia as prime examples. And get this calculation. If central banks that currently hold less than 10% in gold decided to bump that up to 10%,
Yeah.
that alone could mean something like 4,000 tons of additional gold demand.
4,000 tons just from bringing holdings up to 10%.
That's their estimate of the potential. It's huge, a massive potential driver if it happens.
Okay, wow. So global uncertainty check. Central bank appetite check. What about, regular investors, individuals, funds? Where do they fit in?
They're the third leg of the stool, really, investor demand. JP Morgan sees gold as still very compelling for investors worried about, well, all the things we mentioned, stagflation, recession, currency debasement, your money losing value, and just unpredictable U.S. policy.
Right. And the odds of a U.S. recession seem to be ticking up, don't they? Or at least talk of the Fed cutting rates sooner.
Exactly. That feeds into it. Plus, maybe some shaken confidence in U.S. debt as the ultimate safe haven. We've seen some volatility there. So gold looks more attractive as an alternative.
Okay. And are new people coming into gold? Is the market expanding?
JP Morgan thinks so, yeah. They expect new entrants. And they also see continued strong buying from retail investors in China, especially if the yuan, their currency, weakens.
Interesting.
And there's this other specific thing in China, a new pilot program letting insurance companies put up to 1% of their assets into gold.
1% doesn't sound like much.
Right, but given the sheer size of China's insurance industry, that 1% could translate into potentially something like $27 billion of new demand.
Okay, that's not small change. $27 billion. Wow.
Not at all.
So how sensitive is the gold price to all this demand? Is there like a magic number, a tipping point?
They actually put some numbers on that. Their analysis suggests a kind of break-even level for quarterly net demand from investors and central banks combined is around 350 tons.
Okay, 350 tons just to keep prices stable.
Roughly, yeah, quarter over quarter. But here's the interesting bit. For every extra 100 tons of demand per quarter above that, they estimate it corresponds to about a 2% quarterly price increase.
Ah, okay, so there's a direct link.
Seems to be. And they point out that since mid-2022, this net demand has actually averaged around 570 tons per quarter.
Which is way above that 350 breaking.
Exactly. And they argue that's why gold has been so resilient, why the price held up pretty well even while U.S. real yields were going up, which normally pressures gold down.
Right, that makes sense. Okay, so putting it all together, uncertainty, central banks loading up, investors coming in, how does JP Morgan see the actual price path unfolding? What's the trajectory?
So their specific forecast is for an average price of $3,675 an ounce in the last quarter of 2025.
$3,675 average for Q4 25.
Okay. And then they see it breaking through $4,000 per ounce by the second quarter of 2026.
Mid-2026, wow.
And this is all based on that continued strong demand, averaging around 710 tons per quarter.
Okay, and where does that 7 and 10 tons come from, roughly? How does that break down?
Good question. They split it up, central banks, about 225 tons per quarter, which gets you to that 900-ton total for 2025 we mentioned. Investors using futures markets, they see buying picking up now, maybe settling around 800 tons total, held by the second half of 25.
Okay.
Then ETFs, those funds that hold physical gold, they project around 715 tons of net buying going into ETFs for the whole year 2025.
Significant inflows there.
Yeah, and they note that Chinese gold ETFs have been particularly strong already this year, up something like 46%.
Wow.
And finally, physical bars and coins, they expect modest growth there, maybe 2% year over year in 2025, which works out to about 300 tons a quarter.
Okay, so demand coming from multiple angles. It sounds like a very bullish picture they're painting.
Sure.
Are there any potential risks, things that could knock this $4,000 forecast off course?
Yeah, they do consider bearish scenarios, though they see them as less likely right now.
What are they?
Well, the biggest one would be if central banks suddenly stopped buying, or worse, started selling large amounts of gold. That would definitely hurt the price.
Makes sense.
From a macro perspective, maybe if a whole bunch of trade deals get signed quickly, especially one with China, that could potentially calm nerves and reduce that safe haven demand for gold.
Okay, less uncertainty.
Right. And the last one is if the U.S. economy turns out to be surprisingly strong, really resilient, letting the Fed fight inflation aggressively without causing a recession.
So a soft landing scenario might be bad for gold.
Potentially, yeah. Investors might rotate back into riskier assets, but again, JP Morgan currently thinks these outcomes are less probable than their main bullish forecast.
Got it. Okay, what about silver in all this? We always talk about gold and silver together. Does JP Morgan see silver following gold up?
Their view on silver is a bit more cautious, at least in the near term.
Oh, why's that?
Because silver has a much bigger industrial demand component than gold, right?
Right, solar panels, electronics.
Exactly. So uncertainty about economic growth, manufacturing activity, especially things like Chinese solar demand, that creates some headwinds for silver initially. However, looking out a bit further, they still expect the silver market to be in deficit demand higher than supply in both 2025 and 2026.
So fundamentally tight.
Fundamentally tight, yes. They think silver will have a catch-up window, probably starting in the second half of 2025, as prices for other industrial metals hopefully stabilize or recover.
Okay, so a delayed reaction maybe. What kind of prices are they forecasting for silver?
They're looking at an average of around $35 an ounce for 2025, rising to maybe $39 by the end of that year, and then averaging around $43 an ounce in 2026.
$35, then $39, then $43. Okay.
And they also point out that the gold to silver ratio, how many ounces of silver you need to buy 1 ounce of gold, has shot up recently, over 100.
Yeah, I saw that. What does that usually mean?
Well, historically, sometimes a really high ratio like that has suggested that silver might be relatively cheap compared to gold and could potentially outperform gold later on. It's not guaranteed, but it's something traders watch.
Interesting. So gold leads the way first, but silver might play catch up later.
That seems to be the general picture JP Morgan is painting, yeah.
Okay. Let's maybe shift gears slightly. JP Morgan also talked about gold's more traditional roles, right? As a hedge, a store of value. How does that fit in here?
Right, good point. They do look at that. So, first, inflation hedging. We hear that all the time.
Yeah, is it actually a good inflation hedge? What does their analysis say?
Historically, yes, especially against big, sustained inflation surges. Their work shows that since 2000, gold has generally performed well in most rapid inflation periods.
Most periods. What was the exception?
The big one was the post-COVID inflation spike we just had. Gold did okay, but other commodities actually did even better then, probably due to specific supply chain issues and reopening demand.
Okay, so usually good, but not always the best performer in every single inflationary burst.
Exactly. Now, what about hedging against economic downturns? Recessions.
How does gold do then? Does it help cushion the blow?
It tends to, yes. It often decorrelates from stocks, meaning it doesn't move in the same direction, especially during sharp market sell-offs. And interestingly, historically, gold has often rallied in the year after a U.S. recession officially begins. That's pretty unusual behavior compared to most other commodities.
So with recession risks maybe rising, that's another point in gold's favor.
Absolutely. That attribute becomes particularly relevant in the current environment,
Is that-
according to their analysis.
And finally, the big one,
Mm-hmm.
gold as a store of value, holding its worth over time, protecting against, money printing or government debt.
Yeah, they really lean into this gold's enduring role, especially when people worry about currency debasement or the sheer amount of government debt out there. They point out that gold prices have pretty much kept pace with the massive expansion in the U.S. money supply and U.S. debt over the last couple of decades.
Kept pace, okay.
And importantly, it's significantly outperformed all major currencies since the early 2000s. It's held its purchasing power much better. And recent discussions about the U.S. budget, deficits, that stuff only amplifies those underlying worries about debt sustainability, which tends to make gold look more attractive as that long-term store of value.
Okay, so summing this all up, it really sounds like JP Morgan is building a very strong case for a major gold bull run,
It does.
driven by this potent mix of global risks, massive central bank buying, ongoing investor demand, leading to that $4,000 forecast.
Yeah,
And silver, while maybe lagging a bit initially, is expected to join the party later.
that's the essence of it. They really frame it as a structural bull market, not just a temporary blip, and their report lays out the how and why in detail.
Yeah.
So for you listening, understanding these forces, the geopolitics, the central bank moves, the recession risks, it really gives valuable context for navigating what looks like a pretty complex financial landscape ahead.
Yeah, that interplay between tariffs, potential recession, central bank strategy, it does feel like a unique setup for gold right now.
It certainly does.
This has definitely given us, and hopefully you, a lot to think about. Considering gold's history in uncertain times and seeing all this potential for ongoing instability,
Yeah.
it does make you wonder, doesn't it?
Wonder what?
Just, what level of gold exposure makes sense in a portfolio these days, if you're trying to stay diversified for the next few years. This JP Morgan analysis certainly suggests the forces pushing gold demand aren't going away anytime soon.
A provocative thought indeed. Something for everyone to consider based on their own situation.